Legislation passed in December of 2010 extended many expiring tax provisions. Some items were extended through 2011, others through 2012. The result is a somewhat confusing patchwork of tax rates, deductions, and credits. Here's a quick overview of what will and won't change over the next 2 years. The same 6 federal income tax rates that applied in 2011 continue to apply in 2012. In 2013, however, there will be no 10% rate, and the tax rates above 15% will return to their higher 2001 levels. Like 2011, long-term capital gains in 2012 are generally taxed at a maximum rate of 15%. If you're in the 10% or 15% tax bracket, a special 0% rate generally applies, meaning you'll pay no federal tax. However, these rates also expire at the end of 2012. Beginning in 2013, a 20% maximum rate will apply to long-term capital gains in most cases. Most individuals in the 15% tax bracket will pay the tax at a rate of 10%. And while long-term capital gains tax rates also apply to qualifying dividends in 2012, in 2013, qualifying dividends will be taxed as ordinary income, subject to the increased 2013 tax rates. It's important to note that the end of 2011 marks the expiration of the last in a long series of temporary alternative minimum tax fixes. While there could be another extension, as things stand now, in 2012 AMT exemption amounts drop dramatically from their 2011 levels. It's also important to note that 2013 will feature the imposition of 2 new taxes created by the 2010 healthcare reform legislation. Beginning in 2013, the hospital insurance or Medicare portion of the payroll tax increases by 0.9% for high-wage individuals. Also beginning in 2013, a new 3.8% Medicare contribution tax is imposed on the net investment income of high-income individuals. If you're a small business owner or a self-employed individual, note that the bonus first-year additional depreciation deduction drops from 100% in 2011 to 50% for property acquired and placed in service during 2012. For property acquired and placed in service during 2013, there will be no bonus first-year additional depreciation deduction, as normal depreciation rules will apply. In addition, the maximum amount that can be expensed under Internal Revenue Code Section 179 drops from $500,000 in 2011 to $139,000 in 2012, and then to $25,000 in 2013. A number of other key tax provisions and deductions expired at the end of 2011. Unless extended by additional legislation, these items will not be available in 2012. Several other provisions are currently scheduled to expire at the end of 2012. What will happen going forward? Congressional action is likely, but exactly what provisions might be affected and how is uncertain.